A kid wants to save money to build a candy factory. He opens a jar, drops in a few dollars, and realizes the jar is slow. He needs a place that's safe, helps him keep track, and maybe even pays a little extra while he waits. That place is a bank. He walks in with dollars. The teller smiles, types his name, click. His dollars become numbers on an account. Nothing magical happened. The bank now owes him those dollars on demand. If he taps his card or transfers money in his app, the bank moves numbers from his account to someone else's. The numbers are just the score. The bank is the referee that keeps the score fair. The kid asks what the bank does with all those dollars. The banker shows two glass jars behind the counter. One is a small reserve jar. It holds a slice of everyone's deposits, so people can withdraw cash, and payments can clear smoothly. The other jar is bigger, and it says loans. That's where his dollars go to work. Most deposit dollars don't nap in a vault. They leave the building as loans to people who are building things, like candy carts, delivery vans, ovens, or houses. A baker from across town comes in with a plan to sell caramel bars outside the stadium. The bank checks her numbers, her experience, and the value of the equipment she'll buy. If it adds up, the bank creates a loan. On the screen, the baker's brand new deposit appears. Fresh dollars she can spend at the equipment store. The kid's dollars didn't physically fly across the room. The bank created a deposit for the baker and recorded a loan as its asset. On the bank's books, the kid's deposit is a promise the bank owes him. The baker's loan is a promise the baker owes back. Loans aren't free. The baker pays interest because she gets to use dollars now and return them later. Deposits sometimes earn interest because the bank gets to use those dollars in the meantime. The bank lives in the space between those two rates. If it pays the kid 1% on his savings and charges the baker 6% on her loan, the 5% gap pays for tellers, apps, fraud protection, rent, compliance, and a safety cushion. What's left is profit. When competition is strong, banks fight to offer better rates and features, and that gap gets squeezed. The kid swipes his debit card for a couple of gummy worms. On the network, his bank sends a message to the candy shop's bank. At the end of the day, banks settle with each other. If his bank owes the shop's bank more than the reverse, they shift dollars over special accounts they hold at the central bank. That's how the score stays honest across the whole town. Most payments are just clean ledger moves between banks, finished by a final settle at the top. The banker points to the small reserve jar again. Not everyone withdraws cash on the same day, so the bank can safely lend most deposits out, but not all. It also keeps a capital cushion, money the bank's owners put in, to absorb surprises. If a few loans go bad, that cushion takes the hit so depositors don't. Safety layers stack up, reserves for day-to-day, capital for losses, risk checks before lending, and in many places deposit insurance that promises small depositors they'll be made whole, even if a bank fails. Rumors are bad for banks. If kids panic and line up to pull out all their dollars at once, even a healthy bank can look empty. That's a bank run. To stop a silly rumor from wrecking a perfectly fine bank, deposit insurance calms people, and the central bank can lend emergency dollars against good collateral, so payouts continue while nerves settle. Calm returns, the line disappears, and the loan jar keeps funding real work. The kid asks how the bank decides who gets a loan. The banker says they look for candy stories that make sense. A borrowed dollar should help generate more than $1 of future cash after costs. A candy mixer that triples output. A delivery van that doubles routes. An oven that bakes evenly and reduces waste. Good loans are boring on purpose. Steady payments that come in like clockwork. He wonders why his savings rate feels small. The banker points to a wall dial labeled interest rates. The central bank turns that dial up or down to cool or warm the whole economy. When the dial is low, borrowing is cheap and savings pay less. When the dial is high, borrowing slows and savings pay more. The bank's offers move with that dial because its own funding costs move with it. He also notices fees on a brochure and asks about them. Some services just cost money. Wires, foreign payments, fraud monitoring, ATM networks. The bank can charge small fees or bundle them into accounts. A good bank is clear about this, so people aren't guessing. He asks what happens if the baker can't pay. The bank tries to work it out. More time, smaller installments, maybe a refinance. If it truly fails, the bank takes the collateral it agreed on, like the candy equipment, sells it, and uses the proceeds to reduce the loss. That's why the bank cares about down payments and collateral values. Lending is trust plus math. The kid opens his app and sets two goals. One bucket is factory fund, pure savings for his down payment. The other is every day, so he isn't dipping into factory dollars when he buys snacks. The app shows a tiny bit of interest accruing. It's not fireworks, but it's movement. He turns on automatic transfers, so part of every paycheck slides into the factory fund without him thinking about it. A month later, the baker wheels past the bank with a grin and a stack of receipts. Sales are strong. She makes her loan payment. The bank credits interest to depositors, including a few cents to the kid. His numbers grow. Somewhere across town, another builder gets a loan to buy a delivery scooter. The jars behind the counter keep breathing. Deposits in, loans out, payments through, cushions topped up. The bank doesn't make candy, but it quietly connects kids with dollars to people with plans. And the plans turn into ovens and carts and jobs. The kid counts his factory fund and smiles at the distance left. He's moving faster than the jar at home ever could. The teller waves as he leaves, and the loan officer meets a new customer with a sketch of a packaging machine that fits perfectly between two mixers. Please like and subscribe.